they want to try and maintain economic order and prevent a Mad Max scenario from happening, which is what would happen if we get a stock market crash and the economy goes into a seriously deep recession, they're going to have to continue printing money.
Welcome, everyone, to another episode of Inside the Markets presented by StockPulse.com. We are more than honored to be sitting down today with Dave Kranzler. Dave covers the precious metals industry. He writes several newsletters as well. You can find his work at investmentresearchdynamics.com. And he's also, I think, been to a Grateful Dead show or two. Thank you so much. Thank you so much, Dave, for joining us today.
Hey, thanks for having me on, Justin. I appreciate the invitation.
So I guess as the year comes to a close, the gold price doesn't look so bad. Certainly, I think a lot of people would expect more action considering the amount of money that's been printed since the lockdown, as the IMF terms it, the Great Lockdown. So I'm curious, what's your read on particularly the silver and gold prices right now?
Well, I mean, there's a couple different factors at work. First of all, once the Fed dumped over $3 trillion at once into the banking system, the precious metals sector, I mean, took off like a bat out of hell. In fact, between, say, mid-March and late August, it was the best performing sector by far of any of the stock sectors. The mining stocks were, if you just use GDX, I mean, and some of the junior mining stocks, the true junior mining stocks, not the ones in GDXJ, had, tripled or quadrupled in that time period, some even more. And the price of gold shot up, and it was the best performer in the commodities sector, and the whole sector got extremely overbought. I've been doing this sector for 20 years, and I would say in the last 6 years, since we came out of that sort of 4-year mini bear market between 2011 and the end of 2015, you've had, retail investors have had, and retail traders have had a lot more access to, electronic type high-tech trading platforms, and obviously hedge funds have gotten really sophisticated. So what happens is when the sector heats up, a lot of money floods into it, and it's not, by market cap, it's not a big sector. So all the public mining stocks globally, their market cap combined is smaller than the market cap of each individual's stock that's the top 10 stock in the S&P 500. So that just to give you, sense of relative size. So when you have a fair amount of capital that floods into the sector, it tends to, in a very short period of time, it tends to exaggerate, trading gains to the upside. And so what happens is when the sector, well, let me just preface this part with, you can't have a conversation about the precious metals sector without talking about, the official intervention that goes on, and I don't care if people don't believe it. I mean, over the last 20 years, I've seen enough hard evidence, and there's been implicit admissions from official sources that include Alan Greenspan and Paul Volcker. So what happens is when the sector gets technically overbought, that's when the banks who are charged with price control in the sector say, oh, now's a good time to stop this rally, and we're going to do our best to put a lid on it and push it lower. And that's essentially what's happened since August 2020. The entire sector has been in kind of a downtrend since then. If you look at, and I won't go into the specifics on how the manipulation happens. I mean, people in your audience who are intimately familiar with the sector have seen all the arguments, so they can decide for themselves. But, so gold's been in a downtrend since early August or mid-August 2020, as well as the mining stocks. And I mean, that's just kind of the way the cyclical patterns go in this sector. And on the assumption that the Fed's going to make sure we don't have a stock market accident, um, I would say the sector right now is basing for another big move. And in conjunction with that, I mean, I look at ratios like GDX to gold ratio or GDX to the S&P ratio all the time. And right now, relative to the price of gold, the mining stocks are, if you take away the the sharp sell off and rally on the chart that happened in March 2020, the mining stocks are as cheap as they've been since early 2019 relative to the price of gold. And if you look at them, just say versus the S&P, I mean, they're as cheap as they've been relative to the general stock market since the third quarter of 2018. And I mean, you can even take it back further than that. If you go all the way back to, well, GDX didn't exist prior to mid 2006. There's been two previous times when the mining stocks were this cheap relative to the S&P 500. And the first one was when the mini bull market bottomed in late 2015. And then in late 2018, the sector also, we had another sharp sell-off after an extraordinarily sharp rally. And both times that this ratio got as low as it is now, we've had a big move higher. And I see no reason why that's not going to repeat. I mean, notwithstanding what the propaganda the Fed's putting out there today about their monetary policy. I mean, the economy's growing weaker. The Fed's at some point, they're going to have to reverse their taper and start printing more money. And it still remains yet to be seen if they ever actually will hike interest rates. Because if they hike interest rates, they're going to throw our entire economy into a very, very nasty recession. I would argue that it's already in recession now, but it'll get worse. And you'll have, I think, you'll have an inflationary depression. And that's nitroglycerin for the precious metal sector.
The Fed. Can you speak to their monetary policy and where you see them taking it? Do you see them tapering? And then how might an inflationary depression play out? We keep talking, oh, it's a recession. We're in a recession. And at what point do we label the state of the economy a depression, or do we just use the word recession now almost as a euphemism, therefore?
Well, I mean, depression is really just a really nasty, deep recession. So, it's an extreme contraction in economic activity. In terms of the taper, I mean, they've laid out that they're going to, they'll be done tapering in March, and, that'll remove the quantitative easing that they have in place. And then apparently there's a consensus forecast for 3 interest rate hikes in 2022. So, whether or not both of those events actually come to fruition, we'll see. I mean, if you read the Fed policy statement, they stick commentary in there that gives them a back door that they can slip through and reverse the current monetary policy of tightening. I mean, and it's not even really tightening. I mean, it just means they're going to stop printing money after March if they follow through on what they say they're going to do. But that's still going to leave, the several trillion that they've already dumped into the banking system circulating in the system. I mean, some of it is in the form of bank reserves, but a lot of it has been transmitted into the real economy via various credit transmission mechanisms, bank loans, derivatives, things like that. So, and in terms of the interest rates, I mean, who cares if they're going to hike, up to 1 or 2%. I mean, in order for them to break inflation, they're going to have to do what Volcker did in 1981, and that's or between 79 and 81, and that's jerked the Fed funds rate up to 18%. And if they do that, they'll throw this whole system into the worst depression that we've seen in the history of the country. So I don't see them doing that. I think, in fact, I mean, all of the positive economic reports we've seen, the only reason they're showing positivity is because they're nominal numbers that have inflation built into them. You know, retail sales, factory orders, durable goods orders, things like that. So, you know, inflation is everywhere in this system, and it's getting worse, and it's going to continue getting worse. We saw that with the PPI print yesterday. So I don't know if you know, the markets and the system can withstand interest rate hikes. And you know, they can say that they're going to, you know, stop the direct QE, but they have other facilities out there in place that they can kind of they're hidden liquidity facilities, you know, swap interest or swap facilities, currency swap facilities with EU banks, the standing repo facility that they set up. I think it was in the July meeting, without giving an explanation why. When they're in the middle of doing 1.3 trillion of reverse repos every day, you know, overnight reverse repos, they set up a repo facility. I think it was 500 billion. You know, and it's just, it's like, you know, what are you doing if you're trying to keep 1.3 trillion in excess liquidity and suspended animation every day? Why are you all of a sudden setting up a facility that potentially adds $500 billion of liquidity to the banking system? And you know, well, I mean, it makes sense if you realize that they're backed into a corner, and it's essentially print money or die, and that's where we are. And the same thing in terms of interest rate hikes. So, I mean, they may follow through on this, and they may have a reason for wanting to pull the rug out from under the stock market. I don't know, but you know, if they want to try and maintain economic order, and prevent a Mad Max scenario from happening, which is what would happen if we get a stock market crash and the economy goes into a seriously deep recession, they're going to have to continue printing money, whether they do it overtly or covertly, which is what some of these facilities are designed to do. And I just don't see them raising interest rates. So, you know, who knows? We'll see. No one knows for sure.
I don't want to spend too much time on it, but how would they sell that change of projected policy to the public? I mean, I
Well, I
get
mean, they've built in some verbiage in the FOMC policy statement that lets them point to that and say, well, this part of the economy isn't developing or advancing the way we expected it to, and it's continuing to be weak. You know, like they when they talk about their target rate for Fed funds, which is basically between 0.25%, but the effective funds rate is more like, you know, 0.06%. And they say with inflation having exceeded 2% for some time, well, I mean, inflation is, using real measures of inflation, has been double digits for some time. The committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessment of maximum employment. Well, as of the last employment report, notice they don't define maximum employment. Well, for the first 50 years of my life, maximum employment was defined as 5% or lower. And we've been under 5% for quite some time right now. The unemployment rate as of the last employment report was 4.2%. And then I notice, you know, and I don't listen to his speech, but I see his post FOMC speech, but I listen to you know, I watch the byline scrolling by Bloomberg News, Bloomberg TV, and he says, well, you know, we're watching the employment participation rate and it's still too low. Well, it's been in the low 60s for a long time, and it's been below 65% since 2010. So, you know, they can just keep, you know, and it's going to stay in the low 60s for a long time going forward. So they can just keep pointing at that and say, well, we just, you know, on one hand, they're saying the labor market is tight, because I've seen that verbiage scroll across the screen. And then on the other hand, they're saying, well, the labor participation rate isn't high enough. Well, you've got basically 38% of the working age population that isn't considered part of the labor force. They're not working. Now, a fair portion of those are retired, but a lot of them have, can make ends meet living on government entitlements. Um, the bonus pandemic payments that the government was handing out, and I think to some degree they're still handing out unemployment insurance, et cetera. So, and that's part of the reason why you have this huge reservoir of potential labor. When the labor market isn't tight, if businesses would raise wages enough, I think you'd see a lot more people going back to work.
You mentioned this Mad Max scenario that could play out in an inflationary depression. I want to kind of speak about that. So Brian Williams just signed off of MSNBC after 28 years there. And whilst in the past he's exaggerated, the situations he's in, coming under fire, being in a war zone, etc., he did note that it seems like, essentially, he said experts are burning the house.
I mean, I would hate to comment on it out of context. I have no idea what he's referring to.
So we can just focus in on the deflationary or inflationary depression and the Mad Max scenario that you foresee.
Sure. And again, I mean, he may be saying, the government spending is out of control, which it is. The deficits are out of control, they're getting higher. He may be, pointing to the Fed's monetary policy, which has created this massive inflation that we're seeing. I mean, price inflation is evidence of monetary devaluation. Inflation is a product of monetary policy. And when you print money, pedantics will say, oh, well, they don't print money, they create bank reserves. Well, it's basically the same thing. When you print money like that, when you expand the money supply at a rate that exceeds the expansion in wealth output, and I would argue that on a real basis, meaning ex inflation, we haven't had material wealth output probably since 2007. But anyway, when the money supply grows much faster than the real GDP or the GDP, even the GDP, that's what creates inflation, because you have more dollars chasing a lesser amount of wealth that's produced. You see what I'm saying? And and so prices go up. It's basically simple supply demand. There's higher demand using more dollars for, just say for simplistically, a fixed amount of goods that are being produced, and that's the price is going to go up. I mean, that's what happens. So, and that may be what he's referring to. So, what I talk about with the Mad Max scenario, and I mean, that refers to social unrest and the types of activities that households with starving children will resort to put food on the table for survival. And, I saw a poll, I forget who conducted it, but it wasn't a politically based organization that conducted it. And they polled households on their holiday spending plans. 11% of them responded that they don't have enough money to spend money to buy Christmas gifts this year. I mean, that's more than 1 in every 10 household. So, that's the type of economic situation that engenders resentment. And you're going to have inflation get a lot worse, and you're going to have more and more households that are having problems making ends meet. I mean, I haven't seen the survey updated, but within the last couple of years, there was a survey that showed that something like 78% of all households essentially live hand to mouth. In other words, they make just enough money to cover their monthly household expense nut, plus maybe a little bit of discretionary spending. So when you throw inflation into the mix, all of a sudden, a lot of those households are thrown into a deficit position. So, at some point, you're going to see resentment in the masses, and we're already seeing that with increased violence in all the big cities. All these reports of gangs going into stores and looting them, like out in the open. So that's we're edging into that Mad Max scenario already. It's already happening.
How bad could it get, do you fear?
I, man, I have no idea. I mean, I'm probably as bearish as anyone out there on the system, and I don't want to rain on the audience's holiday cheer parade. So let's just say I hope I'm wrong on the way this plays out.
I watched, and normally wouldn't bring this up on this show, but since it is the holidays, I watched Miracle on 34th Street last night. It's a movie that I watched a lot when I was a child. However, all of it went over my head at that point. And so, are you familiar with that movie?
I am.
It's quite interesting. So, I mean,
It's Jimmy Stewart, right?
I'm not sure. I'm not sure
Yeah, it's
who
been a
is in
long
it.
time since I've watched it, but
I would recommend rewatching it because it is so pertinent to today, even still. The doctors are the experts and they're insane, right? The psychologist is actually the insane one. And they're Santa, who is filled with joy and goodwill and wants to help people and believes in joy. He's crazy and everyone paints him as being crazy. Um, the parallels are quite like interesting today. So I guess to raise the spirits of this talk, can you speak about maybe some of your I guess favorite Christmas movies and or maybe anything that has to do with I guess finance and Christmas as we wrap up here?
sure. I mean, I would say I'd say my favorite Christmas movie is probably Home Alone and Trading Places. Trading Places is probably number one. That's one of my favorite movies of all time. Anyway, I've watched it like 20 times. It is really funny. There was a point in my life, a couple decades ago, when I could sit down and watch it and recite the dialogue as it was rolling out of the actors' mouths.
Interesting. I'll definitely be sure to watch it this Christmas season.
No,
So,
you got to watch it. You got to watch it.
any other
It's an annual
comments?
thing for me.
Great. We'll definitely put it on soon. Any comments as we close 2021 as it relates to the gold market or what you see coming for the gold market in 2022?
Sure. I've actually been fielding a lot of emails from newer subscribers, and they're getting frustrated, ready to throw in the towel. And unfortunately, a lot of the ones that I'm getting the emails from, because I would say well more than half of my subscriber base has been around for more than 2 years, which I kind of take pride in that statistic. But the ones that have been newer, say since March 2020, when the sector took off, um, they're starting to get extremely discouraged. They started buying these mining stock ideas at higher levels than where they are right now, and a lot of the newer participants in the sector are throwing in the towel and getting out of their positions. And I've seen several of these bull bear cycles, or bull correct and then correction cycles, over the last 20 years. And the thing about it is, if you measure it from the end of 2000, which is kind of, the time period when the bear market that started in 1981, it bottomed out and ended, in the new bull cycle started. If you measure it from then to now, gold has been the best performing asset of any asset out there. I mean, I'm not including Bitcoin in there because Bitcoin wasn't around, 20 years ago, but and obviously it's had a meteoric rise. But if I'm talking about comparing gold to the major stock indices and other asset classes that people can invest in. So it's been the best performing asset since the end of the year 2000. Silver, I can't remember because I haven't run the numbers for a while, and I haven't run them recently. But silver is like either the second or third best performing asset. I think the Nasdaq is either second or third in there also. So it's those three. And I mean, like I said, looking at that chart comparing GDX relative to the S&P going all the way back to 2006, whenever the mining stocks have sold down this much to the type of level where they are relative to the S&P, you've had a rip roaring rally that's followed. Now, that doesn't mean it's going to happen right away. I don't know. But I will say that I do expect the sector to rally. I think, the Fed's tapering is going to backfire on them. It's going to create an even deeper recession than we're in right now, and they're going to have to reverse their policy and start printing money again. And I don't know if they'll ever get to raising interest rates. However, on the assumption that they do start raising interest rates, there's a guy named Adam Hamilton, and I used to subscribe to his newsletter a long time ago. It's probably worth subscribing to, just for a short period of time. He's really quite wordy, and I get tired reading his reports, but he's done an excellent study that goes back to the early 1970s. And what he found was, and this is just hard data, statistics based on hard data. What he's found is that the best periods of rate of return for gold, and therefore the entire sector, occur during periods when the Fed starts an interest rate hike cycle. And the reason for that is because by the time the Fed starts hiking interest rates, everyone in the market sees how bad inflation is, and everyone knows how far behind the curve the Fed is on trying to rein in inflation. And obviously, inflation is great for gold. And that's kind of, if the Fed does start to raise rates, I think the sector moves higher either way. But if it does start to raise rates, I think a lot of people will be surprised when a precious metals rally follows after that.
We've had the honor of sitting down today with Dave Kranzler. Dave Kranzler's writings can be found at investmentresearchdynamics.com. Thank you so much, Dave, for joining us today, and happy holidays.
Same to you, Justin, and thanks for having me.
Our pleasure. And thank you, everyone, for listening.